Hey, what's up, guys? I hope you all are doing good. I'm doing well. I just wanted to make a quick video and tell you guys the importance of the PE ratio in S&P 500. So, if you look at the blogs and the websites and all the other stock and financial outlets, most of the news channels are portraying that a stock market crash is right around the corner and then we are gonna get screwed, and this stock market crash would be like no. So what's happening here is they are advertisers. They make money while advertising you and sell you the fear. So you get out of the market and then they can put the money in, and in long term, as we have noticed that the stock market seems to go up. So what I did is I gathered some data on PE ratio. So if we look at the PE ratio currently of SPY, which is the Spider's S&P 500 index ETF, this tracks the top 500 biggest US businesses based on the market cap. You will notice that the current PE ratio is hovering around 27. So they will tell you then that the average PE ratio or price to earning ratio has been around 15 to 20. So if that's the case, then we should see this in the numbers, right? And what I did is I gathered the data from this website called macrotrends.net, and I gathered the data of how much PE ratio has been historically over the past 90 years, and then 30 years, and then 20 years, 10, and 5. And what I did is I exported this in an Excel file, and this is the number. So what I'm showing here, I have selected last 30 years of month to month PE ratio for S&P 500, and if you see here, starting from line number 810, which was January 1st 1994, the average PE ratio was 21. Then in February 1st 1994, the PE ratio was 20.56. So every single month, the first of that month, what was the PE ratio? So that this gives us that. And if you look at the average after the 30 years time period, which accounts to close to 400 entries here, the average comes out to be 25.15, and this accounts for 365 months of data. And the maximum PE ratio was at one time 122, which is obviously very high, and the minimum value of PE ratio has been just 13, and the average is still 25.15. So what's happening here is these news channel outlets and everyone is telling you that S&P 500 is at its all-time high and you should not buy it, but the PE ratio on average has been over 25 for the last 30 years. This includes the crash of 2008, this includes the dot-com bubble of 2000 to 2002, and everything in between, and still the average comes out to be 25. So do I think the PE ratio of 27 is little high? Of course I do, but it's not that high that you do not keep investing in S&P, especially if when you know that this index over a long period of time is supposed to go up. It does see some drops, but do I expect one coming really soon? I do not think so. Maybe a correction of maybe 9 to 10% would be coming really soon, but then again, the PE ratio won't drop down to 13 or something that people will tell you. So that is what has impacted my today's return. If you see, I'm up close to $1,200 today. This portfolio I have is at its all-time high, close to $178,000. Then I have Roth IRA and 401k accounts as well. So all of these I try to invest most in Nasdaq 100 index ETF or S&P 500 index ETF, which is SPY. So that's about it. Thank you guys for watching. Just wanted to show you guys this interesting fact and wanted you to keep on investing and keep invested in the index ETFs. I hope you guys will like this video. If you haven't already subscribed to my channel, please do so, and I'll see you guys in my next video. Till then, take care of yourself and people around you. Goodbye.